Homework exercise 11-15, note payable. Consider the following note payable transactions of custom video productions. So we can click here to view the transactions and journalize the transactions for the company. So record debits first, then credits. Select the explanation on the last line of the journal entry table. So here with the first portion of the problem here, we have on May 1st, 2024, we purchased equipment costing $17,000 by issuing a 1-year 6% notes payable. So out of this transaction, we are going to be getting equipment. And again, equipment is an asset. And since it is going up, it is going to be debited here for $17,000. So we'll go ahead and start by inputting equipment and then 17,000 here as a debit since we are increasing equipment. And then we used a note payable and didn't use cash for this purchase here, so we'll be using notes payable, which is a liability, and then liabilities increase with a credit on the right. So we'll go ahead and input 17,000 there to balance the transaction. And then purchase equipment in exchange for a 1-year 6% note will be our explanation here at the bottom. And then we can go ahead and check our answer. Nice work. As a side note, some students want to try to calculate interest, but on the day that we issue the note in August 1st, no time has elapsed because remember the formula for interest is principal times rate times time, and no time has gone by, so on the day that we owe or the day that we issued the note payable, there's no interest yet. Okay, and now it is December 31st, 2024, and accrued interest on the notes payable. So every day we owe a little bit more interest, but we don't record that interest payable every day. So we will wait until the end of the year because the end of the year is when we create the financial statements like the balance sheet. So we have to show all of our liabilities as of December 31st. So we have to record that accrued interest. And what does accrued mean? Accrued means something is accumulated, in this case, interest. So interest is accumulated but is not yet paid. So now notice we're not going to pay on December 31st. We just need to show how much interest we owe. So again, that formula is principal times rate times time. So we owe interest from May 1st until December 31st. So how many months is that? We have May, June, July, August, September, October, November, December. So that is 8 months worth of interest out of 12 that we will need to accrue here. So let's go ahead and pop open our calculator. We're going to take that principal amount of 17,000 for our full note payable, and we're going to multiply that by the 6% rate on that note payable. So this would right here would be for a full year's worth of interest. However, we are only calculating 8 months out of 12. So we're going to go ahead and divide this number by 12 in order to get the monthly interest rate here. And then we're going to go ahead and multiply that by 8 since 8 months have accrued for a total of 680 in interest. So now we have to show that interest expense here. And remember with the expense, we increase expenses with a debit on the left side for $680 since we owe that amount. But again, remember we are not paying the interest here, we are just accruing it. So therefore we will be doing a credit to interest payable since that is a liability that is sitting on our books here. So we credit that amount here on the right since interest payable is again a liability. And then we can go ahead and input our explanation here, we have accrued interest expense at year end. So again, we're not paying it, we are just accruing it in order to show our interest expense accrued at the end of the year. So this is just an adjusting entry that an accountant would do. Most bookkeepers would not do this type of journal entry here. So let's go ahead and check our answer. Good job. We'll close out our calculator for the moment so we can read our next portion here. So on May 1st, 2025, we paid the notes payable plus interest at maturity. So what happens to this note payable once we pay it off? Well, it goes away. So how do we make a liability go down? With a debit. So we're going to put note payable here, and we're going to debit that for that full $17,000 since we are getting rid of it. And then remember at the end of the year on December 31st, we owed $680 in interest here. So what happens to this $680? Because remember, we're going to pay the note payable plus the interest. So we have to get rid of the interest payable. So I'm going to go ahead and input interest payable here. And then liabilities are lowered here with a debit on the left here. So we're going to go ahead and input 680. And then next we need to show how much interest expense has accumulated from December 31st to May 1st of 2025. So how many months is that? That is January, February, March, April. And that's only through April because, again, that's the last month that was completed before this. So that is 4 months of interest expense that we need to account for here. So let's go ahead and input interest expense and then get our calculation here going. Again, that's going to be the principal times rate times time formula to calculate how much that expense is. So we'll go ahead and input 17,000, which is that principal amount, times 0.06, which is the interest. And then we have to figure out that interest for 4 months. So we'll go ahead and divide this by 12 to get the monthly amount. And then go ahead and multiply by 4. And that amount here that we'll debit out of interest expense or to increase interest expense is $340. And then these two together would be the amount of total interest that we're paying. So now we have to get ready for the payment here. So in order to pay it, we need to use cash. And then we can do this one of two ways. We can balance the transaction by adding these through. So that will be this way here. So that's the 17,000 plus 680 plus 340. And that's for a grand total of 18,020 total that we'll be paying here. And go ahead and enter that through. And then the second way you can calculate this is by adding the principal amount that was due for that 17,000 and calculate the total interest due as well. So in order to do that, we'll take the 17,000, which is our principal amount, times the 0.06 rate, and that is for the full year. And that's going to equal 1,020. And that's just, again, the total interest that we're going to be paying. And then we would add on the 17,000, which is that principal amount that we owe for the equipment. So we can go ahead and add that, and we get the 18,020 that we can go ahead and credit to cash. Since we are lowering cash here as an asset, we credit here on the right. And then last but not least, we have our explanation here. So that's going to be paid note and interest at maturity. And then we can go ahead and check our answer down below. Fantastic.